Picking individual stocks can feel like trying to find a needle in a haystack, right? It's overwhelming. But what if you had a simple, really powerful checklist, one that's inspired by one of the greatest investors of all time? Well, today we're going to put one company through that very test. Let's see how it holds up.
All right, so here's our game plan. We're going to walk through a quick 5-step analysis. We'll start with the why behind this method, then we'll check if the company's stock is cheap, if the business is profitable, and if it's financially safe. And then we'll wrap it all up with the final verdict. So the company we're putting under the microscope today is Huntington Bancshares. You might know it by its ticker HBAN. But honestly, this isn't just about one company. We're really using it as a case study to learn a simplified version of Warren Buffett's whole value investing philosophy.
I mean, this is the million-dollar question, isn't it? You've got thousands of companies, endless data, news coming at you 24/7. It is so easy to get lost. The whole idea behind a checklist like this is to just cut through all that noise and focus on a few critical things that really, truly matter.
Okay, so first things first, and this is straight out of the Warren Buffett playbook. Don't overpay. You could find the best company in the world, but if you pay too high a price for its stock, it can be a terrible investment. So our very first check is all about the price tag. Are we looking at a potential bargain here? So how do we measure that? The classic tool is the price-to-earnings ratio, or just PE. Think of it like this. It's the price you have to pay for $1 of a company's annual profit. Now, generally speaking, a lower number is more attractive. So let's see what the PE for HBAN is. Okay, the current PE ratio is 12.21. Now, a number by itself, it doesn't really tell you the whole story. You might be looking at that and thinking, is that good? Is that bad? Well, we need context.
And here is that context. That current PE of 12.21, it's just a little bit higher than its own 3-year average of 11.34. So what this tells us is that it's trading just a tad above its recent historical valuation. And just like that, check 1 is done.
So the price seems, reasonable. But what about the business itself? A cheap stock isn't a bargain if the company isn't actually any good at making money. And that brings us right to check number 2. Is it profitable? And for this, we're going to look at something called return on equity, or ROE. This metric is a big one. It tells us how much profit the company is squeezing out for every single dollar that shareholders have invested in it. It's a key measure of business quality, and with this one, higher is definitely better.
Huntington's current return on equity is sitting at 8.57%. But you know the drill by now, right? How does this stack up against its own recent past? And here we see a potential yellow flag. The current ROE of 8.57% is actually a bit below its 3-year average of 9.80%. So what does that mean? It suggests that while the company is for sure still profitable, its efficiency in generating those profits has dipped a bit lately. For a bank, that could be due to all sorts of things, like changing interest rates that are squeezing their lending margins.
Okay, so we've checked the price tag, and we've looked under the hood at its profitability. Now it's time for our third and final check, safety. Is the company built on a solid financial foundation? You wouldn't buy a house if you saw big cracks in the foundation, and the exact same principle applies to investing. A fantastic way to check that foundation is the debt-to-equity ratio. It pretty much just asks how much of the company's stuff is paid for with borrowed money versus money from its owners. As you can probably guess, a lower number here is a very good sign. It means less financial risk.
And for Huntington, that number is 0.53. So to put it simply, for every dollar of value owned by shareholders, the company has about 53 cents in debt.
And the trend here is actually really encouraging. The current ratio of 0.53 is lower than its 3-year average of 0.58. What this tells us is the company is actually becoming less reliant on debt over time, which is a big thumbs up for financial stability. Okay, so we've got our 3 checks in. The stock's a little more expensive than its average. It's a little less profitable right now, but it's also carrying a bit less debt. So how in the world do we put all this together to get a final verdict? For that, we've got to turn to the absolute cornerstone of Buffett's entire philosophy. And that big idea is the margin of safety. It's simply the gap between what you think a company is really worth, its intrinsic value, and the price you actually have to pay for it on the stock market. This gap, this cushion, it's what protects you if things don't go exactly as planned. Now, using a common valuation method that estimates a company's value based on its future expected profits, we get a calculated margin of safety of 19.03%. So,
what does that number actually mean for us?
It's actually pretty simple when you break it down. The analysis estimates that the company's fair value is somewhere around $20.96 per share. With the stock recently trading near $16.97, that difference between its estimated value and its actual price, that's our 19.03% margin of safety.
And this really just gets to the heart of everything, summed up perfectly by the man himself. Price is what you pay, value is what you get. The whole game is to try and buy something for a price that is significantly less than its real underlying value.
And just to zoom out for a second, it's always useful to look at the long-term track record. You can see the company has delivered pretty solid returns over the past 3, 5, and 10-year periods. Now, of course, this doesn't predict the future, but it does show a history of performance. So, to wrap this all up, this 3-check system gives us a quick, data-driven snapshot. It's a really powerful starting point, but it is not the entire story. And that brings us to our final thought. Remember, this is an educational framework, not financial advice. So I'll leave you with a question. What other factors, things like the quality of the management team, the competitive landscape, or the economic outlook, would you need to investigate before you made a real investment? That, right there, is where the deeper work really begins.